Hello everyone, this is Jim Lucy, Editor-in-Chief for Electrical Wholesaling and Electrical Marketing, with a special report on the economic impact that the COVID-19 virus is having on the electrical market. In today's presentation, we'll explore some of the weekly economic indicators that you can use to get a sense of where the electrical economy is headed in the coming weeks and months. One of the many challenges that electrical distributors, manufacturers, and reps are facing in this crisis is finding timely economic data that can offer an early indicator of where the market may be headed and when and where any economic turn for the better may be occurring. Local employment data for your electrical contractor and industrial customers and value of new construction lag the market by at least 4 to 6 weeks, and many other economic reports published by the federal government, like building permits, only come out once a month. The editors of Electrical Wholesaling and Electrical Marketing believe we have found the solution. Over the next 10 to 15 minutes, I'll discuss the latest data from some key weekly economic indicators that you can watch to take the pulse of the market. These weekly indicators are initial unemployment claims at the state level, rail freight car traffic, the Baker Hughes rig count, oil prices, and copper prices. Unemployment data from the U.S. Department of Labor and the U.S. Bureau of Labor Statistics highlights the states with the highest proportion of unemployment claims so far in the COVID-19 crisis. We took the data and converted it to claims per 1,000 employees in a state's labor force so that we could compare states of different sizes. This data is valuable to electrical distributors, manufacturers, and reps because it offers empirical evidence of just how big an issue layoffs now are at the local level. On a more positive note, when these claims start declining and start establishing upward trends, it will be a clue for you about when the economy is improving in your states of interest. For the week of March 28th, the most recent data available, Hawaii led the nation by this measure with 73 employment claims per 1,000 workers in the labor force, followed by Michigan with 63 claims, Pennsylvania with 62 claims, Kentucky with 54 claims per 1,000, and Rhode Island with 50 claims per 1,000. Of the nation's 5.8 million claims submitted for last week, California led all states with 878,727 claims, or 15% of the nation's total. Other states with particularly huge amounts of unemployment claims for the last week included Pennsylvania with over 405,000 claims, or 7% of the nation's total, New York with 366,000 claims, or 6.3% of the nation's total, Michigan with over 300,000 claims, and 5.3% of the total. As you analyze the list, you'll quickly find that just 10 states accounted for 57% of the nation's total unemployment claims filed last week. Top 10 states, or bottom 10 states, unfortunately, would be California, Pennsylvania, New York, Michigan, Texas, Ohio, Florida, New Jersey, Washington, and Massachusetts. One of the more interesting leading economic indicators for the overall U.S. economy is freight rail traffic, because it's a measure of the amount of raw materials and finished goods being shipped by rail. The best source for this data is the American Association of Railroads, or AAR, which publishes this data weekly. According to AAR, for the week ending March 28th, total freight traffic was down 11.8% year over year and 7.5% year to date. Look at the year-over-year decline in motor vehicles and parts, a huge 69.5% drop. If you've been tracking the auto industry at all, you know all about how many auto factories have unfortunately shut down. This indicator is a direct measure of that. The AAR weekly report on rail traffic always provides some interesting analysis along with the data. Here's a quote from AAR Senior Vice President John Gray. Rail traffic numbers confirm that the coronavirus is taking a toll on the economy, he said. For example, U.S. carloads of autos and auto parts last week were down 70% from the same week last year as auto production declined to zero and consumer spending has begun to shrink demand. While intermodal volume last week was down year over year 14% overall, total movements for the 5 railroads serving the West Coast ports remained steady for a 5th consecutive week, reinforcing the expectation that we may have seen the bottoming of the Asia-North America trade. However, this week also reminded us that the recent collapse in oil prices is hurting all rail shipments of petroleum products, fracking sand, and steel products. While there remains more unknowns than knowns about the next few months, there are tidbits of encouraging news. For example, year-over-year carloads of grain were up in March for the first time in a year, and March was the best month for rail chemical carloads in 2 years. In this slide, you can see some of the more dramatic declines in freight car traffic on both a year-over-year and year-to-date basis. We talked a little bit about the declines in motor vehicle parts, and now you can take a look at some of the other ones on a closer basis. You can take a look at petroleum and petroleum products, which I would have thought would have declined a bit more, but let's keep an eye on that over the next couple of weeks. If you track the oil market, you are probably familiar with the Baker Hughes rig count, which tracks the oil and gas rigs that are operating. The data is available by state, by basin, and nationally for every week. To no one's surprise, over the past month, this market has gotten hammered. The number of total oil rigs operating is down 32%, with 269 fewer oil rigs operating during the last week of March than there were in March 2019. It's interesting to note how consolidated oil production is in the United States. The Permian Basin in West Texas and eastern New Mexico accounts for 63% of oil rigs right now. The Eagle Ford Basin in Texas is another 10%, and the Williston Basin in North Dakota accounts for 8% of all rigs for oil. That's 80% in just 3 basins. Because of comparatively low prices and demand for natural gas, this segment of the oil and gas market was fairly slow going into the crisis. The numbers have gotten way worse. In total, year-over-year production is down 48%, with 94 fewer gas rigs operating. The bulk of operational gas rigs are in the Haynesville Shale play in the southwestern Arkansas, and northwestern Louisiana, and East Texas area, and in the Marcellus Shale play in Pennsylvania, eastern Ohio, and West Virginia. Here's our fourth indicator, oil prices. Most oil folks say they like to see the price of West Texas Intermediate around $60 per barrel, which is where it started the year. That's the range where everybody reportedly makes money. The price dove below $40 a barrel in early March and is currently in the low $20 per barrel range. This is a level that hasn't been seen in many, many years. Oil prices are historically jumpy, much more so over the past few weeks. There is some optimism if the planned talks occur between Saudi Arabia and Russia on their pricing. It seems like ancient history now, but oil prices lived in the $70 to 100 plus range in 2007 through 2008. With oil, it's all about the break-even price per barrel, and it varies quite a bit by different basins. Companies operate much more efficiently than they ever did, and they have driven these prices for break-even down quite a bit. A 2018 post on oilprice.com said that the Eagle Ford Basin breaks even at between $48 and $61 per barrel, and that in North Dakota's Bakken region, the break-even point is approximately $53 to $56 a barrel, and that the Niobrara and Basin breaks even at about $63 a barrel, while the Midland Permian Basin is about $37 per barrel. Energy analysts don't know how low prices will go, but they all agree that the current crisis will spark bankruptcies throughout the oil and gas market because of how highly leveraged many of the smaller drilling companies are. Economists like to call copper pricing Dr. Copper because it's a leading economic indicator for future economic activity, since copper is used in so many industries, with the construction industry among the leading markets because of its use in wire and cable and copper plumbing pipe. No surprise that the news isn't great for the copper market, with prices down 20% year to date and down 13% over the past month alone. However, there might be some good news when you take a look at the shape of the current chart. Prices seemingly have stabilized around the 220 mark over the past week. We'll be checking this chart closely in the coming weeks. That ends our report for today. If you're looking for more local economic information, check out electricalmarketing.com. An annual subscription to electrical marketing includes electrical sales estimates at the metro, county, and sales level, electric product estimates for 17 product categories at the state level, and access to a construction database with hundreds of projects that is updated quarterly, as well as building permits at the metro and state level and other key economic data. An annual subscription to electrical marketing only costs $99 per year at our special promotional rate. The subscriptions include access to all the market data described in the previous slide, as well as electrical marketing newsletter published twice each month. You can get that either mail or digital in a downloadable PDF format. Some of the data that you'll get in the electrical marketing newsletter includes the electrical price index, which many subscribers tell us is worth the cost of a subscription alone. If you're interested in subscribing to electrical marketing, contact Sonia Trent. You'll see her email on the screen here. Thanks for listening to our presentation on the 5 weekly economic indicators to track. Please give us some feedback if there are other indicators that you would like to be including in future broadcasts of these indicators. Thanks, and have a great day.